Hello, we will run through the basics of adjusting entries in accounting today. So why do we adjust journal entries? We adjust to ensure that all revenues and expenses are correct on an accrual basis on the journal entry. Accrual is the accounting method that records revenues and expenses as they occur rather than when cash is exchanged. For example, James sold a car for $1,000 on October the 1st, but the payment is not due until November 30th. Using the accrual method, the revenue will still be recorded for October the 1st. All companies operate a bit differently. Some receive cash before and some receive it after. With this in mind, we have four basic scenarios: accrued revenue, deferred revenue, accrued expense, and deferred expense in adjusting entries. So firstly, accrued revenue refers to when a job is already done, but the payment is received after. A good way to remember this definition is remembering by accrued equals payment after. With a cherry-picking example in mind, the journal entry will look something like this. This results in an increase in assets and increase in equity as well, as assets equals equity and liability. If we were to adjust this will debit the cash account and credit the account receivable. Secondly, deferred revenue. Deferred revenue is when payment is received before the job is done. Deferred equals payment beforehand. A journal entry will look something like this, which increases the asset account and also increases the liability account, because according to the accrual accounting rule, before the revenue is actually earned, it is marked as a liability. And to adjust this, it will look something like this, which decreases liability and increases equity in order to balance the account. Thirdly, accrued expense. Accrued expense is when an expense is first incurred and then the payment is made. With a salary expense in mind, our journal entry can look something like this. This will increase the liability account and decrease the equity account. For our adjusted entry, we will debit the salaries payable account and credit the cash account, which will decrease assets and also decrease liability. Last of all, deferred expense. Deferred expense is when the cash is paid and then the expense is incurred. For this example, the journal entry will look something like this, which results in a decrease in assets and decrease in equity. If we were to adjust this, it would look something like this. This results in a decrease and increase in assets in order to balance the accounts previously. So a quick tip from me before we go. So in order to decide whether to go with the accrued method or the deferred method, we will go back to our definition. Accrued equals payments after. With this in mind, adjusting entries will be a lot easier. Thank you.